So, after being absent quite a while, I wanted to review Polus Gold, a Russian stock mining company. That is, the reason for the review is first valuation. It's valued quite attractively. The second reason is potential dividends and growth. The company is developing a new mine, probably the largest gold mine currently in development in the world. And the physical production of gold of the company should double by 2027, 2028. So it's quite interesting. Not only gold prices may rise because of the inflationary pressures, the gold price, well, the volume of the company, the manufacturing volume of the company can double. So theoretically, you could quadruple your money by 2028. But let's look at its valuation and how it looks. Okay, so it has recently reported its numbers for the first 6 months of operations in 2024, so we can compare the results to 2023 numbers. So the physical production of gold and the actual gold sales in the volume of actual in ounces haven't really changed much. So yes, the production has increased by 3%, which is actually quite good because not only you have the increase of gold price, but you also have the increase, the physical production increase, which is good. So total revenue this is in the US dollars, has increased by 16%. Nice. Operating profit, okay, that has also increased. Things look good. EBITDA has also increased. No surprises here. Then total cost per ounce sold, $423. All-in sustainable cash costs, $761. The costs have increased, but this is not a dramatic inflation. Production inflation. I'm pretty sure most of the miners in the West has experienced quite a bit higher cost inflation. So that's another thing to look at. So the revenue is increasing quite a bit, and the gold prices are increasing quite a bit, while the company is not experiencing the same inflationary pressures that come for now that the companies in the West do, which is also quite interesting. So okay, this is the information in the US dollars. However, Russian rubles hasn't changed much over this period. However, I would suspect it could change. It could change quite a bit over the next 6 months or so. But let's take a look at the financial statements in the Russian rubles, because we are going to use Russian rubles in valuing the company down the road. But again, the company is very well protected by from inflation. You are actually investing into gold in the ground, and your extracting costs of the gold from the ground are some of the lowest in the world. So you're very well protected. Again, revenue in rubles, well, you have, I think it's a 30-something% increase. So obviously in rubles, it's things look quite a bit more dramatic. Cost of goods sold, yes, it has increased. But again, if we return to this chart, the cost of production hasn't increased. In dollars, the cost of production has increased by roughly 8%. So over here, I would estimate that's something around 20%. So over 30% growth in rubles, revenue growth in rubles, and roughly 20% growth in cost of production. So things look good, and obviously the gross profit margin has increased substantially. Then we have admin expenses. These numbers look phenomenally good. The company is on growing their administrative costs, which is great. they're low. That's thing number one. Thing number two, they are not growing very fast. Then financial expenses, they have gone up quite a bit. The company is borrowing quite a bit and has borrowed quite a bit of money because it is developing a big mine. It's called Sukhoi Log, and it's in Siberia, and it has a very long history. It was discovered, I think, somewhere in the 80s, but it was never developed because of the cost of the development. So now it is finally being developed, and again, the company needs money to develop the mine. Apart from it, the company borrowed partial increases its debt because it has repurchased its own shares, which it was planning to later on sell to, I believe, a Chinese investor, but which didn't materialize. Now it's kind of holding these shares back in the company. So, but now as a present-day shareholder, you are actually drawing more income per share due to the decrease of share capital. So again, interest expense is very manageable, but it went up due to the development of 3 mines, mainly Sukhoi Log mine, and the repurchase of shares. So, well, a 40% decrease in the share capital, which is great. Tax expenses, that's fine. So income after taxes has increased quite a bit. Sorry, missed these expenses. So financial expenses, actually interest revenue. So the company is drawing some interest revenue from its other projects. So gains on revaluation of their assets, and this is this line is the currency exchange differences. So they are kind of offsetting each other. These are the differences due to the fluctuations of between Russian ruble and US dollar and Chinese yuan. So these are non-monetary non-monetary items. Then this income is due to the company getting rid of one of their projects. So that's not something that's going to repeat every year. And so really, we are concerned with mostly this number, not this number. So we are concerned with lower number. That's irregular income. So income per share. Again, the share capital has increased substantially. Then the income per share for the first 6 months is diluted. Let's look at diluted. Let's look at the worst numbers. Diluted, and that's income per share if you include this the distribution of the sale of one of the divisions. If you don't include this, because that's an irregular income, your income per share is roughly 1,400 rubles per share. Looks great. Okay, if you look at the share price, currently share price is around 14,000. So, and you are having like roughly 10% income, net income per share just in 6 months of operations by the company, which looks phenomenally great. You can expect roughly, so if you extrapolate it to the next 6 months, which are for this company normally more profitable than the first 6 months, plus, well, they're more productive in ounces per gold, an ounce of gold. That's thing number one. Thing number two, the second 6 months of operations of the company are probably going to experience, well, they're experiencing much higher gold prices. Again, if you return to the chart of gold, well, gold just keeps going up. So it would be very surprising if the company experienced any problems. Then let's look at the balance sheet. On the balance sheet, what do we see? Yeah. Long-term liabilities have increased, which is bad, but again, interest on long-term liabilities is manageable. The company is able to issue, the company is very reliable, and despite it being in Russia, it is able to issue bonds in gold bonds, so which they're securing with their with gold. So they're actually able to borrow at very low interest rates, despite them being under sanctions and despite them being in Russia. Short-term liabilities are more than being covered by their short-term assets. So great. Long-term assets, I don't know. Again, this is a story about a gold mining company. So how do value the cost of the existing mines? So the long-term assets are probably valued quite a bit more than this. So, but anyway, so the amount of debt is high, but it's, again, if you return to the income statement, the amount of debt is quite manageable. So again, the interest expense minus revenue, the company has plenty after interest income. So the company theoretically could borrow even more money, and and it's going to be fine. And it may borrow more money to continue developing its Sukhoi Log, to develop its Sukhoi Log mine. The other way the company can generate money is through non-paying just organically, by not paying the dividends that it normally would. The Russian companies have a long history of paying a lot of dividends, and in this case, despite the company generating quite a bit of profit, it is not doing that. So it's generating roughly, like cash flow wise, if you look at the cash statement of cash flow, let's switch to that. So this is operation cash flow, which is quite high. So again, that's roughly, I believe that's roughly 1,500. That's going to be roughly what? 143. That's going to be roughly 1,500 rubles per share, per diluted share, which when the share price, like in just 6 months. So that's going to be roughly 11-12% per share in just cash flow generation. That's enormous. And again, that's just in 6 months. So in 12 months, it's probably going to be in the range of 20, okay, let's say 24 to 26%. So the company generates a lot of cash. And these are the cash flow expenses that went to the for the development of mines. So the company generates plenty of cash, may or may not have to borrow more money, but again, it's all manageable, and generates net income, generates positive cash flow, positive free cash flow, and will likely double, extremely likely double its physical production of gold in 3 to 4 years, and will very likely, well, and if gold prices also double, then, well, we can, if gold prices also increase, then we can see pretty staggering results. But anyway, now let's value the company, because that's interesting, like just looking from the valuation perspective. Maybe it's overvalued, maybe it's undervalued. Let's see how it looks. So first of all, let's look at the chart. So that's the chart. It's reached 18,500 rubles in 2020. Then the country unfortunately, went into a disastrous war, and well, the country is at war right now. So the valuations have gone down. Western investors, for the most part, disappeared from the Russian market. However, look at the chart. Technically, that's a monthly chart. This looks like, to me, at least to me, this looks like a flag pattern. So if it is a flag pattern, we can expect the price to reach 21. The target price of this accumulation pattern roughly 21,000 rubles. So that's roughly what 60-70% increase in price. So that's looking at the chart technically. Let's make some valuations. So valuation wise, the again, I'll assume I'll value the cash flow that's the company going to generate this year. I'm going to estimate that the free cash flow that the company going to receive in 2024 is going to be 2,400 rubles. It is probably going to be more, as I would suspect that it's probably going to be 25 or 2,600 rubles, but let's keep it at that. Then for the first 1 to 3 years, first 5 years, I'm going to estimate 1, 2, 3, 4, 5. I'm going to estimate that the revenue growth of the company is going to be just 10%. 10%, again, that's, I believe in US dollars, gold was appreciating, since the early 70s, gold was appreciating at a rate of roughly 8% on average, again, for the past 50 years. So again, I'm measuring here in rubles because we need to measure the price to get back to the ruble price of per share. But I'm not putting the ruble inflation because it's kind of really difficult to estimate the inflation. Well, it's difficult to estimate inflation in the US in the future years, but it's even more difficult to do so in Russia. So let us assume a 10% growth. Then for the first 5 years and a 20% growth in the next 5 to 10 years. Essentially, I'm going to say that from this point onwards, the company is going to double their revenue due to the increase of volume production. Again, this year the company is going to complete the mine. Then I'm going to assume that they're going to ramp up gold production very, very, very slowly over the next 5 years, 25% a year. It's probably going to be faster, but again, I'm just going to make this estimate. Then I'm going to use a very conservative discount rate of around 25%. A lot of Russian stocks are valued right now at a discount rate of around 20 to 25. Again, the country is at war, and I'm keeping this discount rate until 2033. So I'm just going to assume nothing is going to change. The company is going to stay at war. Then I'm going to use terminal multiple of 4. Which is very low. For example, again, if we're going to use Barry Gold, a Canadian mining company, the terminal multiple of on Barry Gold is going to be right now around, I think, 20 or 24, so 5 to 6 times higher. That's the P ratio. Again, I'm making an assumption that the company is staying at war, nothing is changing, and that the terminal multiple is staying the same throughout this whole period. We are just chugging along. In this scenario, the current value of net present value of Polus Gold should be 20,000 rubles. So we are currently valued at 13,400. And in this scenario, it should be valued at 20,000 rubles. Then let's review another scenario, a more pessimistic one. You could argue that gold prices have increased over the past 2 years quite substantially, and you could argue that due to certain circumstances, gold prices are going to decrease, and that's why over the next 5 years the company is going to experience a slower growth. And I'm also going to assume slower growth over the next 5 years. Then I'm still going to use this discount rate of 25%, which is absolutely crazy, and I don't think it's going to hold, but I'm going to keep it for the next 10 years and the terminal multiple of 4. Again, it's discount rate in terminal multiple used for a country at war. Just before the war, discount rate for Polus Gold was 8. So just on the discount rate, the company could double without. If the war was to be over tomorrow, the share price could double and everything would return to normal, which it probably won't. At least not right away. The share price could double. So, however, okay, so 5% growth here, 20% growth in the next 5 years. I lowered the growth percentages. I am using slightly lower free cash flow amount. So in this scenario, the share price is going to be 15,680. Again, that's roughly 25%. Based on this scenario, a quite pessimistic scenario, the Polus Gold is undervalued by roughly 25%. Then, if you assume a really, really, really bad scenario where the growth rate is going to stay just at 10%, which means that the company, again, I'm going to use the same intrinsic value of 25%, the terminal multiple of 4. And essentially, I'm making an assumption that the company is going to develop the Sukhoi Log mine, but it's not going to complete it. It's just going to waste its money, and maybe gold prices are going to just rise up over the next 10 years at their average rate of growth for the past 50 years, and that's about it. But everything else is staying the same. Then we're coming to roughly the same price the Polus Gold is at right now, 13,400. So if you assign to these scenarios the equal probability value, then the net present value of Polus Gold should be 15,000 rubles. So the company is, and the current value of Polus Gold is 13,400. So in my opinion, the fair market value of Polus Gold is around $20,000. I think these scenarios that I just drew these two scenarios are very unrealistic. Even this scenario is, in my opinion, is somewhat conservative. So the company is very likely to start paying dividends in the next 2-3 years, and these dividends are going to be quite large, and the company is likely to double in size. And if gold prices keep going up the way they've been going up over the past, let's say, 10 years, you could, even if things stay the same, you could probably quadruple your money. If not, then if market conditions improve, currently the Central Bank of Russia is keeping interest rate at 20%. If that interest rate is to go down over the next 4 or 5 years, you could maybe increase your money 4 to 8 times. So I hope you like this video. I hope you like this analysis. Thank you. Goodbye.